Hey, Steve.
Hey, Paul.
Happy Friday.
Yeah, happy Friday to you.
August 19th, we got tax deadlines coming down the pike here, so we're feeling a little busy these days.
That's true. It's no time to take off now. It's time to get working.
No, yeah, and it feels a little hard to shoehorn this discussion into this conversation on the tax law change, but it's been a while since we've had some major things like this to kind of try and vet out, and this is certainly one of them.
Yeah, absolutely.
The gift that keeps on giving, tax law changes.
Yeah, yeah. Not a ton, I feel like that's really going to impact our clients a lot, but it's definitely worth discussing some of the changes that are going to happen.
Yeah, it's good. And it's good to talk it through, you and I, to make sure we're thinking about it right and understanding what the rules are. But yeah, most importantly, letting our clients know what's in this new law. Yeah, it's funny. It feels like there's super huge corporation tax things that really aren't going to impact, many of our clients. And then there's a lot of energy incentives, and those are the things that our clients might be able to take advantage of if they're, some of these things. So yeah, new law. It's fun. It's also interesting too to think about this, because I think we've talked about this and we've certainly disclosed this. This is the fruition of the previous Build Back Better bill.
That's right. Yeah,
So they
the scaled down version of it, I believe.
Yeah, that's right. So it's the old Build Back Better bill, and now that they've changed this to accomplish the reduction of inflation, they've changed the name of it to the Inflation Reduction Act. Can you hear the sarcasm in my voice?
Yes. Did they build it back better? That's the real question.
Build back the lack of inflation better by implementing this bill. So yeah, I guess the big things, the more kind of policy interesting things, there's this new corporate alternative minimum tax that's part of this. I mean, so I guess to back up real quick, in essence, there's like spending and investment, and then they're trying to pay for some of this all within the bill to try and make it revenue neutral. I haven't read any analysis of that, if anybody thinks it really is revenue neutral, but that's the theory behind some.
Right. Yeah.
So this corporate alternative minimum tax is one of the things that they think will help pay for this. So this is basically corporations are going to have to pay tax equal to the lesser of whatever their tax was before, what it would have been under the laws before, or 15% of their financial statement income. Which is odd. I guess any of the, and this is only for companies that have annual income of over $1 billion on average for the last 3 years. So,
all right, so we can move on.
We only have a handful of those clients.
Exactly. So it brings back the AMT, which was eliminated by the Tax Cuts and Jobs Act. So we thought we had put corporate minimum tax aside, and now it's back again.
Yeah, it does bring it back, but of course you and I know it's a completely different concept. AMT before was basically taxable income adjusted for certain things, depreciation, stuff like that. This is starting with an entirely different basis for leveraging the tax, which is audited, basically book income from audited financial statements.
Right.
There's also this excise tax on domestic corporations who buy back their stock from the market. There's a 1% tax on stock repurchases.
And that wouldn't apply to ours either, because they'd have to be on established markets, it sounded like, and we don't have clients that are on.
Right. So you can tell they're targeting big giant corporations. And then they're extending the excess business loss limitation for non-corporate taxpayers too. That's something that came in the Tax Cuts and Jobs Act of 2017, I think, if I remember correctly.
Right, it was for tax years after 2020, I think. Yeah, I think it was implemented at that point. And that was for non-corporate taxpayers. You couldn't deduct pass-through business loss deductions more than 500, well, for 2022, it says $540,000 married filing joined and 270 for single filers, I believe.
Yeah. Again, not something, I mean, I've seen it once or twice, but it's just not a big deal.
Right.
And then the last way they're paying for all this, of course, this has grabbed a lot of headlines, is this
Yep.
increasing IRS funding.
Yep.
So
And those agents that are carrying guns, I think, too, is what has hit the headline. That's what the headlines have
I
been.
know, I have heard a lot of people talk about that too. Of course, I don't know, that seems like I don't know why that has garnered so much attention, but there's always been a certain very, very, very small part of the IRS that is involved in criminal enforcement, and it's just like any, just like the FBI or any other federal law enforcement agency. We got to remember, in the end, that's what the IRS is a law enforcement agency.
It's funny. Can I quick tangent on that? I think part of the job description that was posted along with the ability to carry a gun was working like 60 plus hours a week and stuff. Which, as you and I, if we can joke around a little bit, I've never seen an IRS agent work more than like 20 to 30 hours a week, much less like 60. So
yeah, that is interesting. But I think it's important to note, there is this stepped up enforcement, and the Treasury Secretary issued a directive that says, hey, IRS, you have to make sure that there's no increase in audit scrutiny on taxpayers earning less than $400,000 a year.
Yeah.
From my perspective, I never really worry about audit. I guess there's always a worry, but every return we prepare, we've got lots and lots of support and documentation. And if we certainly don't audit, we certainly don't verify. That's not our role, but I'm never afraid of audits because we've got good support and good clients. So I don't know, I'm not too worried about that.
Well, I think it is something good to mention is, that's why we ask all these questions when we do prepare tax returns. That's why we do ask for, documents to support deductions, whether it's, bank statements for on business sides, or whether it's, documents to support charitable deductions, et cetera, so that, we're making sure that we can support the deductions and the tax returns if it were to be audited.
Yeah. Yep. So that's the revenue raising. The spending on this bill, I don't know, big picture, there's a few categories. One is extension of the Affordable Care Act, extending the premium tax credit amounts for health, people who buy health insurance on the state exchanges. There's an increase in the research and development credit for businesses, an increasing amount that could be applied against payroll taxes from R&D credits.
Right. Yep.
I don't know if you want to say anything about R&D credits. From time to time, I'll have clients ask me about R&D credits. It might be interesting to talk real quick about R&D credits. And by the way, it's also worth mentioning, there's a lot of direct to consumer advertising about credits these days. I don't know if you hear it on the radio and stuff like that, especially as it relates to the employee retention credits.
Okay. Yeah.
I would encourage our clients, if they're hearing advertisements about these credits and things like that, and they do mention other credits, contact us. Those credit firms tend to be commission based, and they're just trying to get sales. So chat with us. We can at the very least help you discern these things. But just really quickly, the R&D credit is for investing money in processes, in innovation, in processes, and the way a business does things. It's it's a narrow band of activities that can qualify. And yet there are people in, and yet it's not just like IT firms and biotech. Like if you're an engineering company, or even,
I think manufacturing too.
yeah, manufacturing, and you're designing different ways of manufacturing, you're designing different processes. Those things are available to you. They're highly scrutinized and highly audited.
Yeah.
And we tend to, because of that, we tend to refer our clients out to firms that's all they do, is these kinds of things. And generally they have on staff, they have not only accountants, but they have engineers who are qualified to help discern those things and come up with those credits.
Sure.
So anyways, you feel free to, clients feel free to reach out to us and ask us about those things. But when, if we see those opportunities, we certainly are bringing them up for our clients.
Sure.
So anyways, extending the Affordable Care Act, increased R&D credit available against payroll taxes, and then green energy incentives.
Okay.
That seems to be the big area, these environmental related things.
Yep. So it looks like that, your $7,500 credit on vehicles was extended. So if you buy a qualifying electric vehicle, you can receive that credit. And the other thing to mention that I thought was surprising is, they were caps on, some of the vehicle types. I think on Teslas and on Priuses, where they had phased out, they had hit those manufacturing limits. They've now brought that back. And so you can receive that $7,500 credit, I believe, on those vehicles again.
Yep, that's right. So I suppose the logic originally was to not give one manufacturer an incentive over others to help incentivize all the manufacturers, but they've removed that limit, but they've also added some limits. So the total, it only qualifies on cars that are not, super expensive cars, high-end Teslas and things like that. So
Okay.
the credit can only be claimed on cars whose suggested retail price is below $80,000 if it's a van, a pickup truck, or an SUV, or below $55,000 for all other cars.
Which is pretty hard to find. Well, maybe not. I don't know.
Yeah, I mean, so even though they removed, let's just focus on Tesla here, even though they removed that number of car sales limit, this
Right.
price limit definitely focuses on the Teslas of the world. So Volkswagen, and I think Hyundai, I think, has really a lot of electric vehicles these days. So those will probably be the ones that benefit from these.
Sure.
And the other limit that they placed too was that the cars have to be manufactured in North America, basically. So both the car itself and the battery, they have some sort of test that they're assembled in North America. And if they don't hit that, then it's, instead of $7,500 credit, it's it's half of it, I think, $3,750.
Yeah. The other thing I saw was that you could buy a used car and get the credit too. It looked like it was like $4,000 on a used vehicle. I saw that it looked like it had to be valued at less than $25,000, I think, the vehicle itself. So there's definitely limitations on that as well.
And you have to own it for over 2 years too.
Okay.
And going back to the new cars, the other interesting change in the law is that for cars that are placed in service after 2024, and I'm not sure why that is, why we have to wait, but you can transfer your credit directly to the dealer. So right now, if you get this credit, you buy the car, then on your tax return at the end of the year, you claim that credit. You would then get that credit refunded back to you, excuse me, in April or whenever you file your tax return. Now, you know, you could reduce your estimated tax payments and things like that to get immediate benefit of it. But right now,
Sure.
there's this delay in getting benefit of it. But after 2024, you can transfer that credit to the dealer, and then they can basically reduce the price of the car.
Oh, interesting.
You get like instant use of that credit.
Did you mention the AGI limit on that too, on the
No, I didn't.
credit? Which I think is, so it looks like it's 300 grand, huh?
That you're right. That's the other restriction in addition to the price.
Yeah, so, it's credit, it looks like, is excluded or if your AGI is over 300,000 married, filing jointly. So it's a cliff test too, actually. If your AGI is $1 over, you're ineligible for the credit. So that's going to be a pretty hefty phase out there. I mean, for people who live dual incomes in California.
Yep. Yeah, so that's good. I think they're making it a little more widely available. So then the other thing is energy efficient home improvements. I think up until now, I don't know what your experience is, but I occasionally take this credit for our clients. Somebody does a remodel, and if they blow insulation in their attic, or they put in windows, or they, replace their HVAC system, they bring in their receipts and they go, I spent $25,000, and I go, okay, the credit is like, I don't know, $100 or something. It's
$500, I think.
Yeah, the total is 500, but in the past, if I remember correctly, it was based on different types. Like you could get a couple $100 for the windows, a couple $100.
Right, totally worth it.
And then once you hit that, it was like, okay, that's it for the rest of your life.
Right, $500 limit, lifetime cap on that credit.
But now that's changed.
Yes, the credit is now $1,200 an annual credit limit. So, and it's limited to $600 for any one item. Like you were saying, there was various categories. So it's $600 on any, and then $600 with respect to exterior windows and lights, $250 for an interior door or exterior door, excuse me. And then $500 total, like it looks like on all exterior doors.
Yeah. So it's interesting. That will bring up planning, right? If somebody's going to do a home improvement project, a big project that includes a lot of these different components, I would definitely start talking about, and the annual limit is $1,200.
Right.
I would definitely start talking to my clients and say, hey, you ought to straddle this project in December, so that you can get $1,200 in 1 year and $1,200 in the next
So
year.
do the windows and the skylights in 1 year, and then do the doors next year.
Yeah.
And then it looks like they've extended the solar credit, that 30% solar credit now. The full 30% credit is available through 2032, and then it phases down to 26% in 2033 and 22% in 2034.
Yeah.
So
yeah, that's good. Again, I think we were already in that phase down period.
Yep.
I forget what 2022 is. I want to say it's 25 or 25 or 26%, something like that.
I think you're right.
That's a good benefit. That really does help justify that cost, and reduce the break-even point. I seem to find that people who put in solar, it tends to be I don't know, 5-year break-even point on the cost of that. Helps with that. So
Sure.
Was there anything else in here that you thought that stood out to you?
No, I thought that was, well, I guess, if you wanted to say there was things that were like left out, the carried interest was pulled out. There was several kind of other things. The SALT deduction, that the Build Back Better, I think, raised the SALT tax deduction from 10,000 up to previous, those were all cut out of this bill. So we still have that $10,000 limit, and we still have the, the carried interest income at, caps.
Yeah, I mean, a couple of things to say on both those things. We've been working so hard over the last year on this AB 150 California tax workaround to the $10,000 SALT limit. And if people want to listen to our previous discussion on this, they can, but that California law automatically is repealed if they remove that $10,000 SALT limit. So since that wasn't part of this, that law still is in place, and we'll continue to talk with clients who can take advantage of that.
The 3 people that listen to that podcast know all about
That's
that.
right. You and I. And then on the carried interest thing, this is something that a lot of our clients, we do a lot of work with real estate partnerships. People who put together real estate partnerships tend to participate in those partnerships in this carried interest form. So this is something that was going to really impact our clients. And that was I believe, the linchpin that brought
Yes.
I forget
the Arizona.
Yeah, that's right. Or is her name Cinema.
Yep.
The one who she finally said, okay, pull out carried interest and I'll sign it. So
right.
That was interesting to follow that and see how that all happened.
Sure. Yeah.
And there was a lot of other things in the initial proposals on Build Back Better. There was a state tax limit changes. There were like IRA distribution requirements. There was a lot of stuff like that, if you remember.
Yeah.
All of that stuff has been pulled out. So I guess I'm guessing the seeds have been planted for doing those things later on in another bill.
Yeah.
Yeah.
Cool.
All right. Well, that's good discussion. And again, for our clients, please reach out to us if you've got any questions about this or any other matter.